Now I'm going to show you real examples. That was all virtual, fake numbers, like out of blue. At the moment, I'm going to real screenshot the trades which we made in our club. So we analyze those companies. As I told you before, I always pay attention before I sell covered call, what company do I use? Never just pure stock, whatever out of blue. I choose the company. And I always look at fundamentals, what happened with this business. Now, this company, Holy Frontier, have you heard about this? Probably not, right? Holy Frontier, several years back, fell in price a lot. Okay, it's collapsed. When we analyze this business, this business is a refining business. So what do? They take oil, raw oil, and then refine it, and they produce the final product, which is petrol, diesel, like oil, all this asphalt, like drone, they put it on the roof, some building materials, etc., etc., etc. So a few years back, in 2015-16, the oil price went down, and whole industry collapsed in price. People were fearful. Remember that time, right? And this company went down as well. Why? Because people thought it's in the same industry, so we have to sell it. Majority of refining companies which work in that field, what they do, they pump oil from the ground, and then they refine it, and then they sell. So they have this expense. They suffered because now they cannot sell the oil, and the production cost is very, very high. With this company, the price of the oil is what? Profit or expense? Or it's expense. So for them, if the oil price goes down, they're buying it cheaper. But they wouldn't sell, like petrol, remember that oil prices went from 120 a barrel to nearly $30 a barrel. So it's like 4 times. Did you notice that the petrol in your petrol station went 4 times? No. So what happens? The gap between their expense and their profitability, the sales increased. So this company was making more money than before, but the share price collapsed because people perceived same industry we have to sell. Majority of people even don't bother to look at financial statements. We found this company and we start buying it. So I'm using covered call strategy. So you could just pure buy that company, you would make about 150-200% at that time for maybe 2 years, or you could use this strategy. So the share price was $27. Okay, in the left corner you can see it here, $27.85, and this are strike prices. So that's strike prices which you can agree. You choose when you sell a call, you choose yourself what strike price to sell. At this particular moment, I chose $28. So 15 cents above the price which I paid for the share. How much money I generated? $1.10. So you see that, yeah? So the last trade here, $1.10. That's a screenshot from the market. That's how you know how much money you generate. You know your profit before you place the trade. I don't place the trade before I calculate and I am satisfied with my returns. Okay? So what happens here? I'm getting $1.10, and I agreed to sell the share price at $28, and I paid for this $27.85. So what's my calculation? This calculation I do before I place the trade. And you will tell me if it is good or not. Buy shares $27.85, sell let's say $28 strike price, get $1.10. What's my profit if the share price stays below $28? $1 divided by 27, 3.9%. Now, what I want to show you also, the duration is 37 days, you see? In a month. So, nearly 4% a month. Is it good or good? Fantastic. Now, also, your share price goes to 26.75. So it goes below that. So if the share price goes down, until it falls to 26.75, you're still making money. At the moment, the price of the share is around 40 plus. It went to nearly 60. Now it's pulled back again. So if you invest $100,000, from that trade, you will make $3,950 in a month, in 37 days, to be exact. A lot of people put their money in property. Huge stock there. How much they generate? That amount of money in a year, roughly. Here you can generate it in a month. So what happens if the share price goes up? So you get 15 cents more. Correct. You also get this difference between buying and selling. So what's your profit here? 125. It seems like, oh, I want only 15 cents. It's not that much. But look at profitability, 4.4%. So if you compare the dollar value, 3.9 there and 4.4 here, $500 difference. Pretty good.
Can I go back to the fundamental? The option premium is 1.10. Doesn't mean again, sorry.
It's just whatever people prefer to pay you right now. The buyer.
So to buy the option, they give me $1.10
Yes,
for
correct.
each of my shares.
Yes, correct. So for this, right. So can you imagine if a lot of people believe that the share price is going to go up? Do you think the price of the option is going to go up or down?
It's going to go up.
It's going up. So they believe, oh, the share price is going to grow up, so they're going to buy that option from you. That's why you sell, you make money. For you, it doesn't really matter if it goes up or down. You still get money. In some cases, people don't believe that the share price goes up. So the premium would be tiny. It could be 1% on.
That's why if the market goes down or 27.85 minus $1.10, I'm still on breaking point.
You're still on breaking. Okay? So if the share price, like you said, doesn't go up, stays below 28, so what's your return? Here, 3.9. 3.9. If it goes up, 4.4. Now, the interesting thing about it, I've noticed, that's for girls especially now, information. When you research a company, sometimes you fall in love with it. Seriously, people, oh my goodness, I found this fantastic company with all this profitability. I love it so much. And a month later, somebody is going to take it from me. And they're like calling me, Igor, they're going to take shares from you. What should I do? So let it go. I researched this company. I love this company. Why should I give it to you? What can I do to keep this company? I said, relax, let it go. It's like 5% profit.
Get the money.
Keep the money. Don't care about the money, give my company back. So that's what happens quite often. The reason that companies what? They go in a line or they go up, down, up, down,
Up, down.
up, down. So even if you sell it, it might come back in a month's time, 2 months' time, sometimes 6 months' time, you buy it again. Because the current price of the stock depends on what? On fundamentals or emotions?
Well, emotions.
Emotions mostly. Mr. Trump, like 2 days ago, the whole market was up. Like all shares, like I looked like 100 shares, everything green, everything grows up. Last night, everything red. What the heck? Sorry for my language, but I mean, people stop drinking Coca-Cola or using Microsoft Office or traveling, or what happened within 1 day? Nothing. It's emotions. Majority of stock prices within that specific short period of time, they're based on emotions. Bad news come up, share price collapse. Good news, going up. So what we do, we buy on a bad news environment, but buy good solid stocks. It's like when you go on December 26th, you don't buy shitty stuff, right? You go and buy bags of Prada, right? Or like Louis Vuitton or something nice, which you pay, you know that you're saving $1,000 there, correct? You don't go and buy something which discounted at 2% or 3%. You buy something which discounted 100%. So similar stuff here. We know stock in advance. I have a list of companies which I buy. Whenever bad situation on market happens, that's where I bam, 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 jump, buy. Okay, good? So, another company, Yandex.
Who determines the call option, the price?
The price, the market.
The market.
The market.
Price, but the
No.
price.
You can set, I want to sell much, but if at the moment it's $1.10, you cannot get $2.
So the market determines.
Yeah. But you can set, I want a $2. If nobody sell you for $2, buys for $2, you don't create this trade. But it's you to determine the price which you want to sell it for, okay? But
So you
the
determine
market
price
determines.
at the 28.75.
Correct, correct.
And do you have the obligation to sell once the time is up?
Yes,
You have to.
yes, you have to.
Even though the price might have jumped to like 40.
Correct, correct. That's why this strategy called selling covered calls. Why it is covered? Because imagine the situation in this particular case. If you decided to sell a call without having shares, You can do that too. If you have account more than $100,000. Brokers will allow you to. But what kind of risk is there? So imagine you promise somebody that you're happy to sell shares for $28, but you don't have that share. And the share jumped to $40. What would you do in this case?
You need to buy the $40.
You
and
have
sell it
to give it back. So
in a committed
huge risk.
contract.
So that's why this strategy called covered. So you buy shares, you're covered already if the price has jumped. And usually it jumps because we buy undervalued, good, solid stocks. But if you don't want to do the covered call on a shit company, on a bad company, which has chance to collapse, you can sell a call because you know the company is going down. In this case, your shares is not going down. So it's another strategy. It's naked calls. I'm not talking about it today, but it is possible to do as well. All right.
Do you ever get where the prices come down a little bit and they still try and execute it even though it doesn't make sense for them to execute?
Never happens.
That doesn't happen.
Never happens. I've never met that city people who just buying the stock below the current price.
It might be automated. They might have automated it, so, and they're just executing it.
It's all automated. It's like at the moment you don't have to do a lot of stuff manually. It's all automated on the stock market. Very easy to work compared with one time I started. You have to call to the broker and tell, look, execute this, execute. Now it's all automated. I can do it from my smartphone. That's how easy it is. Really, really easy. Now Yandex. Who knows Yandex? Girls, you know Yandex, right? So do you know Google? Okay, Google no. So it's Russian Google. Do you know Uber? That's Russian Uber. They have Yandex Taxi. Do you know PayPal? They have Yandex Money. So this company is huge in the sense of products. It's integrated different products. They also have eBay, like Yandex shops.
Amazon for Russia.
So they have a lot of cash coming in. 4 years ago, what happened between the United States and Russia?
Cold War again.
Sanctions. Correct. Whole investor was scared. The prices of all Russian stocks collapsed. Yandex fell down as well. But the thing is, people still using internet. They're still paying for ads. They're still using taxi. They're still buying stuff. They still transfer money. The company was growing at profit, but the share price collapsed. Perfect opportunity for us. Political issue. We didn't know how long it's going to last, but we knew it's impossible to keep the stock so low because it's a huge profitable company. So what happens with this stock? At the moment, it's went to nearly 50. At the moment, it's about $39, $37. So it's even from that price, more than like double, nearly double. Okay. So in this particular case, I want to show you how we played on downside. So we buy company at $22.33, and I agreed to sell it at what price? 22. So below the price I bought. Why would I do that?
Most people thought that maybe the market was going up. No.
How much am I generating for the strike?
130 per share.
130. So if I'm losing 33 cents, how much am I making?
130 still.
$1, 97 cents. So I'm still profit. So that's why I can sell below the price I want to do. I purchase because I still collect money. So in this case, what happens? I bring in my average price even lower. So my risk profile goes lower. So if I choose $21, how much I'm going to generate? $1.60, even more. And why can I do that? Because I'm losing $1.33, but I'm getting $1.60. So I can move the price down. I will have less return on the base cash return, but I'm reducing my risks. All right? So what happens here? How we calculate the profit? If the share price stays below $22, went to below $22 because it was above, we're going to generate cash profitability, $1.30, divided by 22.30, it's 5.8%. This is real screenshots from my brokerage account. 5.8% in what time frame? 37 days. If the share price stays above $22, how much money I make? 4.1%. So it's vice versa. If the stock goes down, I'm making more money in cash. If the stock stays in the both level, I'm making a bit less money, but still making money.
You said you made the money in 37 days.
Yes.
What does it mean? That they can execute the option only at the end of the 37 days?
Usually they do. They usually don't.
They can do it before the
They
meetings.
can, but in 98% they don't. Usually
Because
they,
they want to wait until obviously
Yeah.
the very last time to see
Yeah.
how much is
yes,
profit
correct,
for them, and
correct,
how much
correct, yeah.
capital to put into it.
The only reason why they do it because they want to buy shares because of dividends. They know they buy the shares and it's at dividends day when they record the shareholders. They want to buy shares the day before in order to get dividends. That's the only reason why people do that. The rest of them they will keep it until the very end. Okay, so yeah.
You chose this company because the fundamentals were good, but
Correct.
the political risk
Correct.
happened. But surely the political risk is not going to be resolved in 37 days.
So that's why I'm keeps to do what? Selling covered calls. Constantly. I don't know when it's going to be resolved. Nobody knows when the problem. Usually we buy when the company has problems, at least perceived problems for the clients. We never know when it's going to be resolved. If we knew when, oh my goodness, guys,
Obviously,
we'll be all billionaires.
you
Okay,
change.
so-
You don't
But
buy
the
it.
thing is, you have to consider what happens if the problem resolved. The share price is going to escalate straight away. It made 50% growth like Yandex did in 2 months' time. You could make 50%. But I don't know if it's going to happen this month, or next month, or month after that. What should I do? Should I wait and sit on the share and expecting that it's grow, or I can sell and generate 5% a month? That's no-brainer. That's the money which I can use and buy my food, pay for my car, pay for my apartment, rent, whatever. Do you understand? So that's why it's always consideration. You make 50% or you make 5% but secure. Okay? So that's why people use options. All right. So New Skin. Do you know New Skin? Ever heard about this company? It's big company, 35 markets, 53 markets, sorry. And fantastic company, absolutely amazing company, have a lot of products. And the interesting thing, their license was taken in China because they were accused in brainwashing people. License
The license,
in China, it was taken away from them.
the license of the company.
Yeah. And a month later it was given back. But within this month, the share price collapsed. Okay, because people, oh my goodness, the biggest market fell apart. Okay, but then it started recovering. Fundamentals of the company were fantastic, great. We analyzed this company, we bought this, and that's what they trade with rate. In this particular case, the share price went down. So that's why I wanted to show you several trades which we made and show how we act if the share price doesn't go up on that day. So the price is $35.30. And the strike price is $35. Again, 30 cents below. So what happens next? The calculation. We collected $2.65 here. If you divide 265 and minus 30 cents, which you're losing basically because you're selling below the price you purchased, it's 6.6%. And that would be also about a month, because that was 12th of December, the trade, and until January 16th. So about a month, a bit more than a month. That's what I cash generated. My break-even price now is what? $32.65, correct? Here. So I brought my average price down. Next month, the share price collapsed. It went lower. What's the price? $38.78. My contract expired, worthless, so I didn't sell the shares. I have the shares. I kept the money. What do I do next? Again, I sell at $35 strike price. Same strike price, but in this case, I don't get $2.65. I get how much? $1.33. So what happens? I'm generating, because my now break even $32. I got that cash, so it's like seems like I'm investing only $32. What's my return on investment? 4%. Fantastic, right? And my break-even price, what happens with it? Went even lower. So it was $32.65. Now it's minus $1.33. Now it's $31.32. Is it below the current price? Yes, it is. So even the share price collapsed nearly 15%. I'm still in profit.
So did you have to buy those shares previously at the $38?
Yes,
Did you-
I bought it at
actually
35.30,
you've already bought
30.
the
So
actual-
and I still keep the shares. Okay, so what happens here? After that, it's expired worthless. Then the share price, it was below 35. I see the trend, it's growing. I keep the shares, I don't sell another call. When the share price grows up, why would I sell a call? I wait until it's finished growing, and then I sell a call. Okay, because I want to profit from the growth as well.
Is it two separate transactions of you buying the shares and doing the call? Like,
Correct.
You have to import the shares separate or not?
Absolutely. Two different. So first you buy the shares and then you sell a call. So it's like you buy a house first and then you find the tenant. Absolutely different people. Okay, you trade, same stock market. So here I chose the strike price already above $38. If I chose $6.35, I would get $3.40. So I went to $38 and I collected $1.50. So how much money I generated in this case? $1.50 divided by my already invested money, $31, so it gives me 4.9% on that month. So 1 month after another one. And my break-even point, where it goes? To $29.77. This month, I was wrong. Share didn't stay on that level. It went all the way up, and my shares were taken from me. So I had to sell them at $38. Oh my goodness, my shares were taken from me.
15% on the
How much money I made? If you would take break-even point $29.97, so 38 minus 28, $8 or 23% within this 4-month period. Plus, one time I got dividends as well. Good or good? Now, if you put $100,000, that would be your return 22. Can you live on 23,000 US dollars in Australia? Probably
4
can.
months, yes.
Yeah, some people can't. They spend too much money on children. And,
You could probably go back a couple of slides. Please.
yeah.
I'm just the one before. I'm just struggling to understand why somebody would pay $2.65 for the share, which is currently worth $35.30.
Because they believe it might go to, because before the share price was $50. They believe by doing now, putting $2.65, if the share price goes back to $50, which it went after that, if they do that, they buy shares at 35, sell it at 50.
Right. You're saying it's not because they want to buy 35, they just want to secure shares without investing any money.
Correct.
option.
Correct.
Right.
Correct.
Because buying at 35 doesn't make sense to pay $2.65.
Some people, they would buy shares. I would buy personally shares, but some people buy options. And we actually look at this, but because they buy only for a short period of time, 1 month, it's expiring, then expiring. I'll tell you one secret now, which made for me so much money. I didn't know about this before. I knew about it, but I never used it because I didn't pay attention to that. When do you think the stocks, the share prices of the stocks move up? 4 times a year. Practically every company has 4 days annually when the share price goes up. Correct. Quarterly report. I didn't know about that. And I thought, oh my goodness, the premium is so huge. I can collect like, instead of 4%, I can collect 6%. And the next thing I noticed that I got 6%, but the share price moved 20%. I could make 20. And when I start analyzing that, I realized, oh my goodness, every move what happens when?
They came out with the data.
Yes. So what I started doing? I stopped selling calls over earnings. I keep the shares. But between earnings, usually nothing happens. For 3 months, I can sell 3 calls before the earnings announce, and then I sit and wait. And because I buy undervalued companies with a good quality, analyze them before, in majority of cases it jumps up. Sometimes it goes down, but in this case, what do? I start trading shares again.
So the option.
Okay. Now that's what happened with the stock. That's where I bought first because I believed it goes up. It went a bit higher and then it went down, up, again down, and then all the way. It was taken from me here. It actually went down after that as well. I hoped it will return here and I will enter the position again. No way, it went all the way to $60.
So you use the price to determine that you're going to buy or the price of the option?
First, I use option of share price because I want shares to be undervalued. I don't want to buy Apple when it's cost $220. I want to buy Apple when it's $140. Okay, so that's why I buy on multiples. It's like I'm using value investing principles, like Warren Buffett does. That's how Warren Buffett becomes a billionaire. But Warren Buffett cannot use this strategy. He's too big for that. We can. All right? So if you have account less than $10 million, you can do that easily. If you have billions of dollars, you already can do that.
Why?
Very difficult. Not enough volatility on the option premium. You cannot sell so much options. Okay. It's like when you have one apartment, it's easier to find one tenant. But if you have several buildings full of, it's very difficult to keep 100% occupancy. Okay, similar stuff here. All right. So if you analyze like generally these three deals, that's what happens. Monthly return, first column, that's average. We do a return on these three shares if you just collect the premium. You don't sell shares. The second column, if you made money with taking into account of selling shares as well. Okay, two options. Now, and then it shows your monthly dollar income on the $10,000. And that shows your annual income here. So annual income and annual here. So by investing $10,000, you can generate, the lowest probably was there 4,700 up to 6,000, nearly 700. So that's what return usually option premium bigger. And this is considered to be the most conservative option strategy, selling covered call.
Wouldn't you spend more than 10,000 because you had to buy the shares as well? So you spent, like, you would have invested more than the 10,000.
You can.
No, you would have had to even in that example.
So that's just in order to show you the profitability on the $10,000. You can of course put $20,000. You can put 100,000. You can put $1 million. The calculation will be exactly the same.
The percentages there, return on investment, that assumes you just hold in the shares, you're not mark to market them.
It's what?
As soon as you just hold in the shares, you're not working out like the difference between the purchase price and
That's
what
the second column. This is where they take into consideration the share price. If you're selling it, here they call it. We don't know at the moment. That's the cash flow from selling covered calls. We don't know the price level of the share right now on the first column. So it could be lower, it could be higher, than your purchase price. But we definitely know that you keep the shares, you keep selling covered calls. This is very important.